Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hey, I got a question for you. Do you enjoy paying taxes? Stupid question, right? How about this? How about if you give to an organization that you care about versus giving to Uncle Sam? Stick around. Over the next half an hour, Big Al and I are going to explain some strategies on how to do exactly that. Welcome to the show, everyone. Good morning. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I am with the big man, of course, Big Al Clopine. He is sitting right over there. We're going to get him in the mix in just a second. But when you think about it, did you understand this? Is if you plan a gift to a charity, an organization, that the IRS will actually forgive a tax? People are understanding this more and more because they realize that tax rates can only go one way, and that way is up. That is today's Financial Focus. If you take a look, people are getting a little bit more educated on planned giving, or maybe giving to charity, because in record amounts in 2015, people are giving a lot of money. Look at this, $337 billion in donations. And then where do you think that money is going? Well, it's going to religious organizations. It's going to universities and schools, human services. There's a lot of things that you can potentially do to give your money to forgive a tax and do something special versus giving it to the IRS. By all means, we always have to pay our fair share, but if you can do something special, I think that means a little bit more to all of us. To help us break it down, let's bring in the smartest man in the room, Mr. Alan Clopine. Hey, Alan, I think a lot of people don't understand because we ask clients all the time, hey, are you charitably inclined? Most of them say, no, I'm family inclined.
Sure.
But then when you dive in and say, all right, well, here, if you can give this to a charity, this is going to reduce your tax bill. You're going to give more to a charity and probably more to the family at the end of the day anyway.
Right. Yeah, that's absolutely right, Joe. And I think a lot of people don't realize there are several strategies that can make a lot of sense in terms of actually helping you out tax-wise. And I got to tell you this, it's okay to benefit from your charitable deductions. The IRS wants you to. So it's a matter of knowing what you can do and what you can't do. So today we're going to talk first of all about volunteering, and we're going to talk about making one-time gifts. A lot of you may know this information. We'll go through it quickly. But you may not know about what happens if you give away an appreciated stock. Or what about a donor-advised fund? This is actually when you can take a future year's contribution and deduct it in a current year when you're in a high tax bracket. How about a direct IRA, a contribution to charity? This actually was made permanent. It's been a temporary law, but it was made permanent about a year ago. This can be pretty effective for a lot of you. And then finally, we'll get into charitable gift annuities. This can be a great way to go to give to a charity and get an income stream yourself. And if we have time, we're going to get into charitable remainder trust just a little bit, because that's yet another strategy that where you can give and receive something back, and so feel good about it, but also have an income stream for life.
Let's take a look, Alan. Let's kind of dive right in, because volunteering, you just volunteered yourself. You're down in Tijuana helping out the kids, right?
I sure was. Yeah, and Joe, when it comes to volunteering, first of all, you cannot deduct your volunteer time. That's not deductible, but here's what you can deduct. Your travel and mileage, supplies that you purchase directly for charity, or certain fundraising expenses, those can be deductible as well. And so, Joe, when you look at that, it's like a lot of people will say, well, wait, I'm an attorney and I bill $200 an hour, so if I volunteer for a day, that's 8 hours at $200 an hour. Do I get a $1,600 deduction? No, it doesn't work that way. Your time is not deductible, but direct supplies and fundraising expenses, travel and mileage, those are deductible.
So if I travel to Guatemala, the plane ticket to Guatemala would be tax deductible?
It can be. It can be if that's the primary purpose of the trip.
Look at one-time gifts, because I think a lot of times we just do this on maybe an annual basis. And there's different ways that you can do this, and there's a preferred method, and there's some that are not.
Yeah, some people give cash. That's not the best way to go. You better to write a check or do an online donation, because you have proof of the donation. And you must realize that if you give more than $250 to a charity, you need to get an acknowledgement from that charity. In other words, the charity is required to write you a letter, and you're required to have that letter to support your deduction. So if you're audited, you're going to need that acknowledgement to have that deduction stand.
Here, I think this is one thing that's always missed is that, all right, well, here, maybe I want to give a larger gift, right? And so maybe it's $10,000, $20,000, something like that, and then you give cash to that overall charity. Well, you have to take a look in your brokerage account, because if you have appreciated stock, that is a much better way to go. Because if you give appreciated stock, guess what? You don't pay tax on it. The charity receives that stock, they can sell the stock, and they are exempt from taxes. So if you take a look, I have a stock for $1,000, its current value now is $15,000, so there's a large gain in that overall stock. I get a tax deduction to boot, right? $15,000 tax deduction, and I don't have to pay the tax. Ellen, I think we see this mistake. It's like, all right, well, here, I want to give to the charity. I have my stocks. So they sell the stocks, they pay the tax, then they give the cash to the charity. If they just give the stocks directly to the charity, they get a tax deduction, plus they don't have to pay that tax on selling the stock.
Yeah, that's huge, Joe. And I would say most charities actually will allow you to donate stocks. And when they sell them, guess what? They don't have to pay any tax on that because they're a nonprofit. So it really works for everybody. Now, if your stock has gone down in value, you want to do just the opposite. You want to sell that stock and then recognize that loss on your tax return and then donate the cash. But if your stock has gone up and you want to donate that, certainly donate it directly rather than selling. First, you'll avoid that whole tax.
So, I mean, there's so many different things that are involved in financial planning, right? You got to take a look at your cash flow needs. How much money are you trying to generate from the portfolio that you've, built up for yourself? Then you look at, all right, well, what are the tax implications of all of my moves? And if I want to give to charity, there's different things that you can do to put more money into your pocket, more money to the overall charity. And guess what? It's a win-win-win. Now, here's a really cool strategy. It gets a little complicated. But Al, let's break down a donor advised fund, because a lot of times you can create large tax deductions in a given year and be able to position those assets to charity over your lifetime.
Yeah, you can. Let's talk about what it is and then how you use it. So you open a special account at a brokerage firm, and you get to control how it's invested and how those contributions go out to charity in whatever years that you want them to be. But here's the key, is the year you fund the account, you put the dollars in the account, is the year that you get the tax deduction. So let's say you've got a year where you've got a lot of income. You got a big bonus at work, or maybe you got stock options or something like that, or you sold a property. You got extra income that you would like a special tax deduction. And you're going to give to charity over time. So here's a way to get that deduction right now this year. Maybe you put $20,000, $50,000, doesn't matter, in the donor advised fund. That is the year that you get the tax deduction, the year that you put the money in the account, the same year that you may have high income. Now, in future years, you manage that money and you dole that money out as you see fit to the charities of your choice. You don't get a tax deduction then because you've already received it up front, but it's a great way to match the tax deduction in the year where you're in a higher tax bracket.
Right. We talk about tax planning quite a bit on the show. It's called Your Money, Your Wealth, and we look at, hey, maybe you want to take some money from an IRA and move it into a Roth IRA. Well, that's a taxable event, so that could create a lot larger income in that given year. Well, you can offset that tax by planning a gift and using a donor advised fund. Now you have the money. You're going to give the money to charity anyway. Let's say you give $5,000 a year. Well, you just bunch up those overall charitable gifts into 1 year. You get that nice tax deduction that given year. You get the money into the Roth IRA, for example, and you pay very little tax doing it. So it's a combination of multiple different strategies of what you have to take a look at. A lot of individuals will just look at one thing in a silo. Hopefully now you can see that if you look at it across all different layers of planning, you're going to be a lot more successful. Hey, we got to take a quick break. When we get back, we're going to get into IRA planning, that dreaded required minimum distribution that I know a lot of you hate to take. Guess what? There's a strategy where you can eliminate that. Stick around. We'll get back to you in just a second. Good morning, everyone. Hey, welcome back to the show. The show's called Your Money or Wealth. Joe Anderson and Alan Clopine hanging out here. We're talking about how to give less to Uncle Sam and maybe more to some organizations that you care about. So stick around. We're going to get into a little bit more complex strategies to really get some bang for your buck. But before we do that, let's see how you did on the true-false question.
I need to itemize my deductions on my tax return in order to get a deduction for charitable giving. And the answer to that is actually true. You do need to itemize your deduction. There was, I don't know, maybe about 7, 8 years ago, there was a couple years where they called it above the line, whether you itemized or not, you could take a deduction. But before that and now after that, you cannot. So in other words, you have to be able to itemize your deductions. You have to have enough deductions to get over that standard deduction to actually get any benefit.
And itemized deductions is, your Schedule A, so mortgage and medical expenses and things like that.
Sure. So, Joe, I guess with the true-false question now, it's the time of the show that we actually have a question. One of our clients asked you a question. You have not even heard the question, so we got to see how you do, kind of on the fly, point blank. So let's roll it.
I've been looking at ETFs and mutual funds and not quite sure where to invest. Can you help me to decide where's the best place to put my money?
All right, great question. So a couple of things. There was an ETF, what means an exchange-traded fund. And then there's also a mutual fund. There's two subtle differences. I'm not going to get very complex here because I only have a few seconds. An exchange-traded fund is basically you're buying the market. So if I want large cap, small cap, mid cap, whatever, an exchange-traded fund, I'm buying the entire index, and it's at a very low cost. I like ETFs quite a bit because they're very transparent, they're very cheap, and they're very tax efficient. There's not a lot of trading that goes on. In an active managed mutual fund, you have a portfolio manager that's buying and selling, or she's buying and selling stocks in a particular category of stocks, such as large companies. So they may be saying, hey, I don't want to buy all 500 large companies, I only buy 200 of them. So they're guessing and speculating on which ones that they feel are going to outperform. So when you look at that, 80% of them fail to beat the overall benchmark, so I'd much rather stick with the benchmark, which would be an exchange-traded fund, which is lower cost, tax efficient, and 100% transparent. Boom.
Killed it.
There you go.
All right, and I would completely agree with everything that you said. And part of the reason why they are cheaper, the internal costs are cheaper, because they don't have a fund manager and a bunch of analysts trying to pick stocks. And interestingly enough, those that do active mutual funds, over the long term, they tend to earn the market return minus their costs. So you're better off with an ETF. So I guess the next thing I want to talk about, getting back into our charity. There is a way to donate directly right out of your IRA. This is relatively new. It's a direct contribution to charity from the IRA. You must be over 70 and a half to do that. And you can do up to $100,000 per person per year. Now, if you're married, that's a couple $100,000. But here's the very important thing. It can count as your required minimum distribution. So in other words, if you have a required minimum distribution coming up, Joe, and a lot of people do, the baby boomers are now hitting 70 and a half, and it's like, I got this required distribution. What do I do with that? I don't necessarily need the cash. I'd like to give it to charity. You can give it directly to charity.
Right. So here's the problem is that, all right, well, here, now I'm 70 and a half or older. Then it's a requirement by law that you have to start taking distributions from your retirement account. So you take those distributions, you're getting taxed on that distribution, and then you're taking that distribution and then you're giving it to charity. What you can do now is directly give the dollar to charity, up to $100,000. So if you have a $20,000, $30,000 required minimum distribution, you can directly send that requirement to the charity, and it never shows up on your tax return.
Yeah,
so
or part of it.
Or part of it, yeah,
Sure.
Depending on what you want to do. It's completely flexible.
Right, right.
And so when you look at, all right, well, why would that make a difference? We have an example that we should probably take a look at just to kind of spell this thing out because it's pretty important.
Yeah, and so looking on our screen, the example is a $10,000 donation to charity, and this is a couple that's age 73. They don't have a lot of itemized deductions because their home is paid off. So if they write a check, here's what happens. Their IRA, the required distribution, let's say it's $30,000. Their pension is $30,000. Social Security about $34,000. Deductions $23,000.
See how I'm blowing you up here,
yeah,
Alan? I got this thing going here.
That's really good, Joe. Thanks so much. So taxable income $70,900, and they pay federal and California tax of about $10,300. But what happens if they give it directly to charity? If you can see through Joe's swiggles there. So it comes right out of the IRA. So that doesn't count as a required distribution. So now you're paying tax on $20,000. Your pension is still $30,000, but look at your Social Security. It goes down because Social Security is one of those things when you have less income, less of it is taxed. In this example, instead of $34,000 being taxed, $28,100 is taxed. Notice the deductions, exemptions don't change because they're not itemizing anyway. Taxable income $55,000. Look at that, tax savings of $2,600 with a happy face. That makes me and should make you guys really, really happy. What do you say, Joe?
Yeah, I'm just playing with this thing here. But I mean, there's a lot of numbers.
We need
it's
to
confusing.
take that away from you.
It's like, I don't know what he's talking about, so I'm just kind of scribbling along, just trying to follow along. It gets complicated, but I guess at the end of the day, you save a couple of bucks.
Yeah, more than
right?
a couple bucks.
$2,600. It's 26% savings right there by just giving it directly to the charity versus taking the tax. Because when you get retired, if you're at 70 and a half, you have Social Security. We talked about Social Security many times on this show. And it's called provisional income, of how your Social Security is subject to income tax. So if there's ways, and if you understand this, then you can reduce the amount of Social Security taxation, and so then you can kind of play things around. Also, for those of you that are looking for additional income, there's something that's called a gift annuity. Now, this is not a commercial annuity that you would purchase through an insurance company. This is a charitable gift annuity. Annuity means income, so there's different things that you could do. You could give to a charity, and they will give you a monthly income stream.
Yeah, and typically the monthly payment can be based upon 1 or 2 lives. In other words, if you're married, it will last as long as at least you or your spouse is still living, and you get a tax deduction right up front, and you have income for life. So, Joe, this is one of those things where you can give and actually benefit as well. And in my case, my parents have done a couple of these, National Park Service and as well as Smithsonian. They gave a gift, and they're receiving a monthly payment stream for life. And I want to say, happy anniversary, Mom and Dad. Happy 60th today. So, congrats. How about that, huh?
That's
I got her in.
That was so nice.
Now I have it documented that I didn't forget it.
Oh, Alan. Such a mama's boy. All right, we got to go take a break here. When we get back, we're going to wrap some of this and get it all fine-tuned for you. So there's all the different strategies that we talked about. We're going to list them out so you get them right on paper. And then we're going to flip the show to you. We're going to answer your email questions. We got a couple of good ones, so don't go anywhere. Show's called Your Money, Your Wealth. Good morning. Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine hanging out here, talking about some charitable giving that saves you a couple of bucks in taxes. We're going to wrap up the show, but before we do that, let's go to the true-false question. What do you think we got here today, Alan?
One drawback to a donor-advised fund is that you have to know which charities you want to receive the money when you open the fund. Now, we talked about the donor-advised fund last segment, so that's where you can actually set up a special kind of account. You can put money into it. The year that you put money into it is the year you get a tax deduction, but it doesn't necessarily go to charity. You have this fund set up, you invest it how you want to, and you get to decide what charities get what dollar amounts in the future. It's really a good tool for when you want to take a deduction right now for future year contributions. But here's the question. The question is false. You don't have to know what beneficiaries that you want to give to when you set up the fund. In other words, when you set up the fund, it's not designated. You get to decide later on what charities you want to have receive those dollars.
You know, there's a lot of decisions that people have to make, too, on where to give their money. You know, one of our advisors, Nate Richardson, he volunteered, and we went out and watched him, and it's a pretty emotional clip, but this is truly a pure inspiration.
And I look around, I see all this hope. signing up and lacing up. Hundreds of people are gearing up for the Out of the Darkness Walk.
This band represents I lost my dad.
For Pure Financial Planner Nate Richardson, this walk is about much more than crunching numbers and raising money for a good cause. This is personal.
This is to honor Grandpa. That means we lost somebody. I lost my dad in the early part of 2014 to suicide. And it was always difficult for me to even say that in the last year. But what this foundation is about is getting the awareness out and knowing that people deal with this every single day.
Walking and wearing his father's college colors, Nate supports his father's memory. And his kids are wearing Nate's college colors to support him.
It's hope. It's reassurance that there's other people that are going through the same thing that I did.
Each year, more than 34,000 people take their own lives in the United States. Like Nate's family, thousands of people are stunned by the sudden loss.
You know, we all deal with loss a little bit differently, but the suicide is definitely a unique loss to deal with. Not having any exposure to this in my past, almost having a stigma attached to suicide and the word suicide. I mean, as I was going through this, I didn't know who to turn to.
The Out of the Darkness Walk helps to ensure families always have somewhere to turn. The walk benefits the American Foundation for Suicide Prevention. The nonprofit provides help for those grappling with depression and taking their own lives, as well as the ones who love them most.
One of our missions is that suicide is 100% preventable. So we want people to know what the signs are, the warning signs for suicide. We want people to be able to ask someone the question, are you thinking of suicide? And then also get them to the resources that they can need so that they can get the help when they need it.
Nate says just seeing others who have loved and lost to suicide is therapeutic in and of itself.
And it's just amazing. You look around, you see so many different colorful bands, and it just brings to the forefront that this is a real problem that we're trying to face as a society.
The walkers' combined forces helped to raise more than $115,000. Hitting the streets side by side, they're empowered to make an even bigger impact.
This day to me means that we can tear down the stigma and the taboo surrounding suicide and really get to the heart of the matter and get people help that need the help.
Nate Richardson, pure inspiration.
I mean, there's a lot of phenomenal organizations, either if it's suicide, cancer, leukemia, HIV, AIDS, whatever. We can really make a difference by giving to certain charities. And by doing so, it really makes a huge impact on, someone in your family's lives that you might not even know. So I want to reach my heart out to Nate, and we're all with him at the Pure family. So with that being said, I guess we can flip the show to you and figure out different ways that you can give to charity, but also receive something back in regards to a tax deduction.
All right, Joe, so let's get to our first email question, and I believe this is from Samantha in San Marcos. And she writes, I'd like to send money to a family in Tijuana that lost their father. Can I take a tax deduction for that? Boy, that's a worthy cause, Samantha, but unfortunately the answer is no. Because to get a charitable deduction, you actually have to give to a charity, what's called a 501c3 company. So there are organizations here in the United States that support families like that in Tijuana, and so that would be who you would give to if you want to take the tax deduction. But if you give directly to the family, unfortunately you cannot take that tax deduction.
I thought you were going to say no because it's in Tijuana.
Well, it does have to be a U.S. Charity, but a lot of United States charities do have international operations.
Got it. Let's go to the next email question.
All right, this is from Pete in Bonita. I just received a lump sum from my parents' estate with instructions to give half of it to charity. What are the pros and cons of giving it outright or using a donor advised fund? Well, if you have a charity that you can give it outright to, that's probably a great way to go. A donor advised fund would be great if you don't exactly know what charities you want to give to now, but you want to give out slowly over time. Otherwise, you get the same tax deduction.
It's, what, half dozen in one hand and 6 in another? Is that
True.
Is that something that we can call it?
Yeah, I would say one more thing though, Joe. Donor advised fund does have some annual expenses, maybe about 0.5%. So there are some costs. If you have a direct charity, you can do that, but donor advised fund gives you a lot more flexibility in the future.
Well, I know we jammed a lot of different strategies for you when it comes to charitable giving, saving money on tax. Hopefully you enjoyed the show. If you want any more information, you know where to find Big Al and I. We'll be back again here, next week? Next week, we got another great show lined up. I have no idea what we're going to talk about, but it's going to be fabulous. It's going to be fun. It's going to be hilarious. Have a wonderful weekend, everyone. For Big Al Clopine, I'm Joe Anderson. Boom.